Great. So welcome you all once again to the performance management. Probably is the last aspect of the management accounting program. So it summarizes all what we've done so far together and other road of study, bringing them together. So good. So that is it. So performance management. Performance management.
Not also the battle is confusion.
We have a lot of readings and some calculations. So we will look at some.
Everybody should go quiet in the room.
Readings
I'm doing something. If I see
as well. Great. Now, basically, the performance management talks about three items. One, setting of performance objectives for the organization. So basically, we should know how to set objectives for the organization. So the objectives, strategic plan for the organization. So this course or this subject, the ending section summarizes how we can set objective or set a strategic plan for the organization. So that's the first aspect of it. So, and making plans, then the information required. So also look at the information systems. Information world system. All of these in the handouts. So handy with them out for me. Great. Okay, so the information systems that talks about if you want to set objective or plan, what kind of information do we need to set the plan? There are so many types of plan. Basically, you have three types: the strategic plan, and then the tactical plan, and then the operational plan. Each of them requires some level of what information, and that goes on the information system. If you want to set a strategic plan, you need a strategic what information. If you want to set a operational plan, you need what? Operational information. So basically, that is it. Now, setting of objectives, then next section, after we have set the objective, then we have to now measure the actual performance and see whether the objective is met or they are deviating. So the next section is what? The performance measurement. Performance measurement. That's the next section. And in fact, that's where I'll kick from. So the theory section, the reading section, it will do justice to it, and I'll take it from the performance measurement. So performance measurement. How do you measure the organization's performance? Or we use what we call the performance indicators. So that's what we use to measure the performance. So performance indicators. Performance indicators. Now, here we are going to talk about how to measure the performance of the organization. So it aims to establish how well something or somebody is doing in relation to a plan. So say, first of all, set objective or set a plan, agenda for yourself. Come again and come and measure whether you've achieved that agenda or that performance. Now, with the performance management, we are going to group them into two. That's all. Then I'll talk more about that when we start the actual game. Great. Now we'll have what we call the financial performance. So we are going to use some indicators to assess the performance, to measure the performance. These indicators, we have grouped them into two. We have what we call financial performance indicators. And then we have non-financial performance indicators. Good. So let me put them here. So financial performance indicators. Good. Then we have non-financial performance indicators. Basically, under this section, that is what we are going to look at. Then finally, we look at two sections. Look at the last section called measuring the divisional performance. And that is the end of the game. So I'll pick from this section and look at the last aspect, measuring the divisional performance. Then we are done. Measuring the divisional performance. Good. Here we are going to consider the return on investment. B, let me do them here. B, I want to consider residual income. And C, I want to consider transfer pricing. Transfer pricing. So these are the aspects that we have to look at for. ICAG is the first two. Okay. Now, so let's start the actual game from the performance management. So with this, if you want to measure the performance of the entire organization, the corporate organization, what are the factors that you have to consider? So the factors that you have to consider before we can successfully measure the performance of the organization, some of them are: first, consider the measurement needs resources. So the performance of the organization. So one, you consider the resources requirement. Resources requirement. You know, resources in terms of what? People, in terms of equipment, time to collect and analyze the information to know whether we are doing well. So it means that do we have people who are experts in performance analysis so that they will come and then analyze what we are doing? If we don't have such people, then that means we cannot bring a valid performance structure or performance analysis in the company. Good. And normally HR is very good at this. So that's why at the end of the year, they bring the appraisal forms around to fill. Good. And then the second factor The performance must have objective. Why are you measuring the performance? There must be objective there. It must be in relation to some item or to something. So that's the very first, that's the second factor that you have to consider. Agreed. Good. So we are saying that the performance must have what? Objective. The overall performance should be measured against certain what? Objective. Or it must be related to something or some relation or the goal, the idea behind. So why are you measuring the performance of the organization? Oh, to improve. Or the objective will be to identify the shortfalls or the shortcoming so that we can fill the gap. Good. That is it. And then in fact, over here, the objective is from the plan that you set for yourself, the objective. So it's in relation to the objective. That's why we are measuring the performance. Great. Then the measurement must be relevant. Yes, that's the third point or the third factor that we have to consider. The measurement must be what? Relevant. So relevant. Not that everybody is measuring the performance. If you start measuring the organizational performance, no. It must be in relation to the situation at hand. Good. So this means that finding out what the organization does and how normally runs its activity, so that to measure and reflect the actual situation. So you're not just measuring something else from what organization normally perform. That is it. And the measurement too must be fair. The measurement must be what? Fair. Measurement must be fair. Here is very topical issue. Please, in COVID time, some of the measurements are not fair. The measurement must be what? Fair. Because if you can only hold a manager or employee responsible for action that fall within his what? Control or capacity. That's the fairness that we are talking about. You know that this performance target is not directly controlled in the hands of this employee or this manager. And you're going to appraise that manager against that. You're not being fair. So that is taking COVID, for instance. If you set a plan in 2019 and 2020, we are going to operate for 4 months. So we are going to work for 4 months in 2020. So 4 months, that's your objective. Because 2019 we on and off and off. Now 2020 arrived and then there are a whole lot of issues. COVID scattered things. So in fact, 2019 work was even far better than the 2020. So the manager in question should not be held responsible if I'm measuring your performance. That why is it that the plan that we have set for ourselves, we've not been able to achieve that? That is the fairness of what the performance measurement. So we are saying that the factors you have to consider: one, make sure that your measurement basis is fair. Yes, good. If international prices are going high and are going to use that one to appraise a manager, that's not a fair deal. Good. So basically, that is it. Now, yeah, we have to, another factor that you have to consider is we have to use a variety of what? Of measures, not just one way. Varieties of measures, not just one way. So varieties of measures should be used. Yes, use varieties of measures. It's like you don't need to use just one way. Like we call it dada bampu. If you know how to prepare a certain dish, always that's what you use. Like auditor that know how to audit inventory very well. In the morning when it comes inventory, in the afternoon when it comes inventory, in the evening when it comes inventory. No. You should vary your measures. So today I'm inventory. Tomorrow, let's go to cash. The next day, let's go to PPE in that order. Vary the measures. Why are you doing this? You are doing this because managers may be able to find ways to distort single measure. Yes, you know that this auditor always come to measure events. When they come, no, they gather all the events, the good one, and then bring it to you. If you don't use different ways, you won't get the actual performance. Why? Because if I know that every day when I come, I'm going to check my inventory. I'll make sure that anytime I see your face, my inventories are in good shape. I'm done. You have nothing to say. Meanwhile, there are other aspects that could reveal my performance. That you can check there too. Can check the cash, can check the PP, and then other aspects, my revenue. So that is it. So these are the few factors that we have to. And then don't forget that let's keep in this. I mean, in the plan that you are setting, the objective, the goal, it must be realistic. Yes. So realistic estimates may be required. Even though the sky is our limit, can't tell us that in COVID time, you know that there's COVID. You are still setting a high target. Target that you know that go beyond the capacity of your employees. And include certain items. Be certain with the figures. Don't say unbounded figures. Any amount is good. No. 10,000 is 10,000. 1,000 is 1,000. Be realistic with your assumptions or your plan. So these are the factors that you have to consider when you're going to measure performance. If you don't consider these factors, you're going to make wrong assumptions. Yes. Then finally, the measurement needs what? Responses. So that means any deviation you identified during the measurement process, it needs what? Response. That's the corrective measures must be taken. Good. Good. So if you know how to measure the performance, you should know how to give out solution to any deviation. That is what we are talking about here. Great. Now with the measurement, we can group them into two. We can group the measurement into two. That's the qualitative and quantitative measurement. So the quantitative talks about the numerical figures. So can you give me examples of quantitative performance measure? Quantitative, you assume what? Numerical figures. So for example, qualitative. So quantitative and qualitative. So let me quickly give examples of them. Yes. With the quantitative. Quantitative talks about the numerical figures. So numerical figures. Example, you can tell the employee that you have overachieved your target by 20,000 cities, or tell the employee that you have been absent for 2 weeks or been late for 2 weeks. You are assuming numbers. Then you have the qualitative, qualitative. That one you are describing. Normally we say good or bad. Good or bad. So I'll tell them that, in fact, the chair that I'm sitting on to render my duties, the chair that I'm sitting on to render my official duty is very bad. It let me feel uncomfortable. This is what? Qualitative. Or my chair is very good. Let me feel comfortable and render my duty very well. That is the qualitative. Okay, now we are going to do the indicators. What suggests that you perform well? So we group them together called performance indicators. With these performance indicators, basically we have two types of the performance indicators. We've described them here, that financial performance and non-financial performance indicators. So let's look at the financial performance indicators. Please, in management accounting, we consider all the indicators, both financial and non-financial, unlike financial accounting or financial reporting, that they mostly consider just the financial. Good. Now, the financial performance indicators or measures, we also call it monetary measures. So let's look at it. Financial performance indicators. Let's call it what? Monetary what? Measures. It measures, one, the profitability of the organization. Profitability. Two, your liquidity. I like that too. Your liquidity. I'll talk about your risks. Good. So the financial performance, and in fact, please, these are the ratios: profitability, liquidity, risks, and the other section. So let's give example of some of the measures, especially the profitability and then the other aspects. Perfect. So when I ask for financial performance indicators, the question is this: what suggests that we are doing good? What suggests that we are doing good? So financially, if our profitability look good, liquidity look great, risks a bit low, then there's an indication that we are performing what? Well. So the indicators are just measures that we are going to assess our performance. Good. So when we talk about profitability, let's give some example. In fact, all with the financial performance, it talks about all items in the financial statement. So for those of you who have little knowledge about financial reporting, all the items that you see in the income statement qualify to be what? financial performance indicator, all the items there. So that we have the critical ones. So the critical ones are the revenue, your costs, your profit, your cash flow. You are done. Good. So let's basically look at some few measures. Great. Some few measures. Then we are done. Great. So please, with this, you can be asked to assess the profitability of organization, liquidity, and risks. Here, the risks you can have operational risks, financial risks. Great. And then we will talk about that of the specific examples. So they can give you a financial statement of a company and they will ask you to perform performance analysis to measure the performance of the organization. And last thing, it was there. Just that our questions, we combine the financial plus non-financial. So we are now looking at the financial section. Great. Now let's move on again. So we should know all the ratios that qualify under the profitability, liquidity, risks, all of them. So kindly go through the formulas on how to calculate the ratios using the ratios link. Yes, it has been solved there for you. You just have to go through. Now let's move on. Example, critical example of financial performance or monetary measures. One, can talk about revenue. You can talk about costs, and then almighty profits, right? Great. This has been the major target because profit maximization is almost the ultimate goal for most of the business. Good. So that is it. Because the most commonest measure of all, because the profit maximization is usually cited as what the main objective of most organizations. Great. So here you can set an objective of increasing the profit by, let's say, 20,000 cedis. So that's the objective. Profit must be increased by what? 20,000. Increase profit. Which of the profit? Let's say profit after tax must be increased by what? Go up by 20,000 this year. If possible. That's your performance what? Objective or target. Then you measure and see if the net profit will be more than or will increase by the 20,000 that we are talking about. Good. Then revenue cost. Then we talk about the share price of the entities also. Share price of the entity. Then you look at the cash flow of the organization. So the cash flow of the organization. Right. So cash flow. That's all. So we are done. Great. Great. So these are examples of the indicators. Something that indicate that yes, we have performed well or bad. We can use the revenue, we can use our costs, we can use profit, we can also use share price and cash flow. What we did first, that we look at the profitability, liquidity, that one was the aspect What financial performance talk about? It talks about 1, profitability, 2, liquidity, 3, your risks. Good. Good. That's what the financial performance talks about. But these are the examples. Examples. There are many. They are not limited to this. And then all the ratios. All what? The ratios. All the ratios. All the ratios. So here we should know how to use ratio to analyze or to measure the performance of an organization. Good. So with that, you don't need to worry. I will upload that section on the platform and then you use that one to get it. Good. So how to use ratio analysis to measure the performance of an organization. Good. Which came 2 consecutive sittings. So 2019 May, 2019 November, that was the section that dropped. So we look at it. So revenue, profitability, you can use ratios like what? Gross profit margin, can use net profit margin, and then ROCE, and then the operating profit margin, net asset turnover. When you go to liquidity, current ratio. Yeah, so all the ratio. Most of you have done financial reporting, so good. So I will try as much as possible. In fact, use the financial reporting lecture. So I'll upload the ratio section there. They will use it quickly. Good. Great. So let's see. Now, when we talk about the liquidity tool, I wish I can explain this in a short while. I'll try. Just that I've done a full section on the ratio analysis. So I think let me upload that one and then we use that one instead so that we can move a bit faster. So we should know how to assess the company using what? The profitability ratios, liquidity ratios. The risks, that one talks about the activity, receivable days, the payable days, all of this can be used to assess the financial performance of the organization. Good. Yes, so now let me provide a sound base for reference. Yes. The section that I'll upload on the platform, you need 1, profitability. If you talk about the profitability, the available ratios are gross profit margin, net profit margin. So net profit too is there. But let me talk about operating profit margin. Operating profit margin. Can also use what? Net profit margin. You can also use what you call ROCE. You can also use what you call net assets. Net asset turnover. Net asset turnover. So these are the profitability ratios. First, you should know how to calculate them. They are formulas. And then 2, the interpretation. And all of them has been dealt with in the video that I will upload on the platform. So that is it. So these are the ratios that we have to use to calculate that. Yes. Then let's move on to liquidity. With the liquidity, first we look at the current ratio. Current ratio. What can we do it there? Let me do it. It's a bit bigger than that size. We can use what? Current ratio for liquidity. So let me do it here. Current ratio, quick ratio, then the working capital. So the two, liquidity, we can use what? One, current ratio. Two, quick ratio. It's called quick ratio or acid test, fastest reaction. Three, we can use what you call the receivable days. Receivable days for inventory turnover days. So inventory turnover period. 5, we can use payable days. Payable days. We can also use what you call net operating cycle or CCC, cash conversion cycle. Cash conversion cycle. Conversion cycle. Good. Or you can also call it what? Net operating cycle. So this is what we are going to use to measure the performance of the organization. Yes, net operating cycle, cash conversion cycle is also known as net working capital. Net working capital. All of this has been dealt in the material that I will upload. In fact, it's a full lecture video that explains everything into detail. Great. Then we go to risks. 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 So we go to risks. The risks, you look at this. For the basic risks, I'm going to talk about the gearing. So not all the gearing ratios. So gearing ratios. First, debt to equity. Debt to equity ratio. 3. Look at the debt to capital employed. Capital employed. Look at the interest cover. Look at the operating gearing. All these are financial gearing. Operating gearing. Good. Operating gearing. So these are the risk section. So all these, don't be surprised when you see management accounting question and it has turned to financial reporting ratio analysis. Don't be surprised. It's possible. Then that is all. We are done with the ratios. So these are the ratios that you have to know them for the calculation purposes. Then we are done. I'll upload a material for you that talks about all of them. Okay. Then I'll quickly move on to the non-financial performance indicators. Non-financial performance indicators. So let's look at the non-financial performance indicators. Non-financial performance indicators. Non-financial financial performance indicators. Good. You can call it non-financial performance indicators, NFPI. You can also add the word key to it. You also call it key performance indicators, so KPI. Key performance what? Indicators. So we have key financial performance indicators. You can add the word key to it. When the key is there, it still means the same thing. Great. So now let's continue taking. Now here is very important section. Now, as a manager or in management accounting, we don't just consider only the financial aspect. We consider both the financial and non-financial. So here we are going to consider the following item, very critical. One, changes in the cost structure of the organization. Changes in what? The cost structure. Changes in the cost structure of the organization. It's a critical example or a type of what? Non-financial indicator. Yes, of the organization. Two, we are going to consider the competitive environment. I like this word. Competitive environment. Competitive environment. Michael Porter's what? 5 forces. Good. Competitive environment. Then we look at what? The manufacturing environment. And the manufacturing environment. The manufacturing environment. C. The manufacturing environment. Please, here let me explain this. The financial performance or the financial section of every organization depend on what? The non-financial aspect. Yes. So critically, we have to set a very good and then make sure that always the non-financial section is in the heart of the organization. Good. So that is it. Other example be one, that of the product quality. Critical examples include what? Product quality, number of employees, and then the customer satisfaction. All these, they bring what? The financial section. That's money. Good. Can also talk about good working condition, employee motivation, good public image. Good. And then your competitive stand. So when I pick 5 of your competitors, including yourself, where will you stand? Will you be the first or the last? Good. And then what's the computing environment? Great. So basically, that is it. Now, these non-financial performance indicators have become very topical issue in recent times. Why? But in recent times, organizations have to concentrate on their special areas, or the organization want to achieve the objective, and they realize that without a non-financial, it is very difficult for them to achieve their financial objective because the profit they are looking for does not depend on its own. It depends on the inputs of the non-financial section. Good. For instance, if the condition of service for the employees are very bad, or working environment is very poor, the product quality, it will affect the motivation and it will affect the product quality. If the product is not quality, what happens to the sales? Sales what? Drop. When sales drop, your profit goes down. Good. So that is it. So now we are saying that there has been a number of what going emphasis on the that of these non-performance, so non-financial performance indicators. Why is it like that? Why is it that in the modern environment we are like much interested in this more than that of what the financial section? So let's put some few reasons down why we are placing more importance on the non-financial indicators. Good. So we can talk about concentration on too few variables. Good. Concentration on too few variables. Now, with the financial indicators, few variables, the performance measurement normally focus on or entirely on those factors or those items which can be expressed in monetary terms, which is very, very, very bad. Yes, because now they put much concentration on few items, the non-financial. Good. So that is it. They've pretty much attention on the financial. Almost everything, almost any item, any plan you are going to set, the financial will dominate. Yes. Because if you call small children, ask them, what do you want? They tell that we need money. We need what? Money. So everything must be expressed in the form of what? Monetary. The language that they can understand is what? Money. Apart from that, that's all. Then we can also talk about lack of information on quality. Lack of what? Information on quality. Great. Then the changes in the cost structure. Then the changes in the competitive environment. All these cause for yes, changes in the cost structure. Like they change the competitive environment, changes in the manufacturing environment. All these cause for what? The non-financial performance measurement or indicators. Basically, that is it. Now, we'll quickly move on to the next section where we are going to look at some few illustrations. Illustration. So here we can give you the items like or factors like failure. So defects. Example could be defects of the non-financial measures. So defects. Then so defects we can arrange it by time. So how many minutes do we detect the defects, the quality of the products, the absenteeism? All of these are what the non-financial section. You can also talk about range of products, employee skills, customers, competitors, suppliers. This section contains a large number of information. The non-financial sector contains a large number of information. So, stock out, misinformation, lateness, all of these should be taken into consideration. So you can also talk about the quality of service and then measure of customer satisfaction. How do you measure the customer satisfaction? Is it when the customer come back? Or is it when the customer smiles after using the product or the service? So that's the customer satisfaction. So customer satisfaction can be measured in terms of what? Turning one-time customer to what? Repetitive customers or usual customers. Turning just inquiries to what? To be a loyal customer. That is it. And then reducing the time that the customer normally waits will amount to customer satisfaction. Good. So all of this, then we are done. Now we are going to use what you call the balance scorecard to measure the performance. We cannot explain the performance measurement without giving or without looking at the balance scorecard. So now let's look at the balance scorecard. Let's critically look at the balance scorecard. It's an interesting area that we have to get it. Not that interesting. It's an examinable section. I remember one of the recent sittings they were asked to use the balance scorecard to assess the performance and set objective for a particular company. So let's look at the balance scorecard. Right from here, then we start the actual calculation. Balance scorecard. So as the name suggests, it's a score card, but you have to balance it. Balance score card. But the scorecard is usually one word, not separated. So it's a scorecard. We are done. Now, balance scorecard is the strategic management tool that we use to measure the performance of the organization at 4 different perspectives using both financial and non-financial. That's the interesting section. So that is it. So performance management, both financial and non-financial, and that 4 perspective, and it uses what? Financial and non-financial. So let's take it again. We are saying that the balance scorecard is what? A strategic management tool. So first, strategic management tool. Wow. That we use to measure performance. We use to what? Measure performance of organization and also set objective. Thank you. Then in 4 perspective. So in 4 perspective uses what? Both financial and non-financial indicators. That's all. So that is the balance scorecard. You can also call it scorecard. Okay. So basically that is it. We are going to look at the 4 sections or the 4 perspectives, explain them, then we are done. Good. So let's see the perspective the four perspectives that we are talking about. The four perspectives that we are talking about. So now it was given to us by Kaplan and Newton. They argue that management, when setting objectives, must set objective for the four perspectives and also use that to measure the performance. Good. So the perspectives are you can start by saying financial. So financial perspective. Financial what? Perspective. I'll talk about customer perspective. I also talk about that of the learning and then the internal learn and then internal section. So let's talk about the internal processes. Yeah, internal processes. We talk about the internal processes. Your internal process. How to serve the people. Serve them well. Good. Your customer service. The internal process. Use advanced technology. Then finally, we'll talk about innovation and learning. Innovation and what? Learning. Good. And learning. You have to learn. You have to learn. Do a lot of research work. Learn every day. Learn how to do something new. That's all. How do we improve what we are doing now? Is there any alternative that we can do it better or faster or much easy? That's all. So now let's start from, now I'll provide some smart link. This is a link. The link starts from the innovation and learning perspective. Great. Great. So the innovation and learning is, it talks about how we can do something new and how we can improve, how we can do what? Improve and create future value. I'm saying you are learning today or you are doing research for future, for tomorrow production. You want to improve upon your processes. So every day we have to learn new things. That's the innovation. Good. That's the innovation. And then here it considers the capacity to maintain your competitive position through the acquisition of new skills. So here, all what we have want to do is acquire new skills. New what? Skills. Perfect. And then development of new products. New products development. New products development. New technology. In fact, new ideas. How to create something new for your organization. Good. So basically, that is it. Basically, we talk about how to research and innovate, find something new, new technology, fastest way of what? Doing or rendering the service. So if you are serving a customer, you find a new way of serving the same customer by feeling better than previous. Good. So if you come to certain parts of the country, realize that the standard is different. The standard is a bit high. Yes. Someone said that, of late they cannot be able, to come buy Coffee Bookman at East Legon. Why? Why? Because it's expensive over there. It's not about the price. It's about how innovative they are. They are moving forward. Good. Now we have plantain burger at over there. You see just roasted plantain, putting some small leaves and some other add up to it, increasing it. That's innovation, right? Good. Please, it must be realistic. Good. So that is the innovation and then the learning. I can assure you that if you can put an attitude of every day, I must know something new. Give yourself just 1 month. What you put inside there, everybody will be afraid of you. Every day you have to learn something new. Every day you have to learn something new. It will make you superb. Great. And it will improve your skills. And it will increase the company's capacity. If you learn, either it will let you outweigh your competitors or it will let you maintain your capacity. If you don't learn, other people will learn and come and then outperformed or has you, dump you somewhere if you are not ready to learn within that industry. Exactly. So learn and make sure that always your systems are up to date so that now if you learn and innovate well, it will improve the internal processes. I like that. So have you seen the link? So now this move to the internal processes. So anyone that do a lot of research into the future, in fact, your processes, your internal processes become superb. You excel to achieve the financial and the customer objectives. How we get it? So this internal, if you excel well here, in fact, customer, excellent, financial. Internal processes talks about how you perform your activity, how you serve the customers. Yes, the waiting time. If at the time that you always do the research, learn, innovate, it will reduce the waiting time the customer have to come and then sit down from morning to evening before the customer will be served. No. Good. So that's the link. So if you learn well, you improve your internal processes. And if your internal processes improve, you excel. And when you excel, you achieve the customer objective. And when the customer objective is being achieved, forget about the financial. You get a lot of cash. A lot of cash. That's Apple. Taking Apple for instance. Innovation and learning. Yes. It's not like a certain company that we know. When they introduced the Nokia 3310, it stood there for long. But this year, it's in iPhone 12, right? Next year, it will be different iPhone. The following year, different, learning and bringing something new. Internal processes will be improved. Customer will always be satisfied and give you all the money. Good. So that is it. And it also aims to improve the decision making. Basically, that is it. Now let's talk about customer perspective. You know, if you improve the internal, the customer satisfaction will be achieved. Good. So how do the existing and the new customers value us? What do they value us? Like, how do we create value for them? So here we use what we call customer satisfaction to assess the performance of the organization. Customer what? Satisfaction. Customer retention. You're going to retain about 80% of your customer. Walk-in customers should be retained. Someone is just calling to make inquiries. After call now and become a regular customer. Someone will just aim to just acquire one of your products. You're now buying all the other. Yes. That is the customer satisfaction. And that is the customer retention we are talking about here. All of them depend on what the internal process. When they come, you serve them bad. When they come, your systems are not working. Try, you go, they don't come back again. No. Yes. When they come, in fact, the customer are in to wake the company up or come and sit there. The customer have to come and then open the office for the company. I think the systems are not working. The internal processes, everything is not going on well. This customer will go next time and come back again. Especially if you're a service organization. Your service organization, you do direct with the customer, like hospital, like tuition centers, like educational facilities, you deal with the customer. So when they come and they're not satisfied, well, it's not like products where you can take it away. When you reach home, it wasn't good, you come back again. But with the service, because the customer will be there while the service been going on, if the satisfaction is not high, it will never return back. If you don't return back, forget about your financial. Your profit will be low. That is it. Now the financial, here, how do you create value for our shareholders? That's the question that we have to ask ourselves. How do we create value for our shareholders, our owners? Good. And then that is the end of the game. We can only create value if our customers are okay. They are happy with us. They'll give us all the money, and that money is for our shareholders. We have great value in terms of what profit maximization and maximization of what shareholders what wealth. That's all. Please, all of these you can set a performance target. Performance target. So learning innovation. So every day, one new ways of doing item, internal processes. We have reduced the production time by what 20 minutes. That's the target. Customer, we have to retain 70% of the customer who walk in. Financial profit must go up by 20%. These are the target you have to set over there. These are the objectives you have to set over there. Good. Then that is it. So the financial perspective, you can set the goals like survivor, succeed, and prosper. These are the financial perspective. Let me list the goals that you can set over here. Then we bring this to a successful end. Great. Great. So now let's look at some specific objectives or specific targets that you need to set. So when you talk the financial perspective, the goals will be, now you should know the difference between goal or the objective. Agreed. So goals slash what? Targets slash the objective versus goal one side. Then the measure. What are you going to use to measure that? Also one side. So what are the goals? Financial. Let's talk about survivor. So you have to set a goal for survivor. So survivor goals, right? Yes. Survivor goals. So goals for survivor. So survive. And then you have to also set a goal for succeed. Success. Yes. Succeed. So success. Then you have to also set a goal for prosper. Oh yes, you have to move on. Increase in the growth. Like we have to increase our market share, return on investment. Everything must increase. Yes, you have to prosper, making huge profit for organization. So these ones are goals. They are targets. They are objectives that we have to set for ourselves. So when I'm going to write the ICA, should have what? Financial perspective or financial target. Your financial target might be survival. The funds that I have might survive me from now to I write my paper, or from now to I qualified or I just from the institute. I have to succeed with a little fund that I have here and prosper and make it to what? Increased. That's all. Now, what are the measures? Survival. Yeah, there are so many measures that we can use to assess the survival of the organization. One, you can use what? Cash flow. Cash flow. Oh, if you have consistent cash flow, that means your survival is in good shape. But in situation where you have a liquidity challenge, your cash flows in off, today you have little, tomorrow all what you get used to pay your suppliers, you have leaving nothing for investments. So that means your survival is in doubt. Your survival is in doubt. You can also use your profits. Company that making consistent losses, your survival is also in doubt. You can also use acquisition and retention of what? Key management staff. Good. Can also influence your survival. Then let's go to succeed. What are the measures are you going to set for succeed? Can talk about sales growth. Sales growth. So sales growth. Or you can also talk about your operating income. Increase in operating income. That's all. The growth in operating income. Then we are done. Prosper. We can talk about the return on investment. We can also talk about the market share. The market share of the organization. Market what? Share. We can talk about the market share. We can talk about the market share. Good. So basically, that is it. Now let's move on to that of the customer perspective. So let's move on to customer perspective. Customer perspective. So I'll just have to take this section off, then take the goals off, then come towards the measure. So customer perspective, what will be the target are you going to set for your customer? New products. New product, yes. We have to serve our customers with new product too. Every day they have to get used to our product. So every day let's try them with a new product. until they get used to that particular product. So that is it. So new products, customer perspective, new products. That's one. Customer partnership. Customer partnership. Customer partnership. And then preferred supplier. Here it talks about the customer. The customer, the one that we sell our product to, and then sometimes the one that we buy, the supplier. So you can also talk about the responsive supply and then the preferred supplier. Good. Let's go to responsive supply. Quickly, we have to be critical and respond to all orders. When customer order for 1,000 items, how long does it take out to respond and reply and even deliver the goods? Sometimes if we don't have, some of the organizations, they don't have, they won't tell you. They'll tell you we are coming, we are coming. We are waiting, we are coming, we are coming, we are coming. I don't realize the time that I need the item has passed. So customer or supply responsiveness is very key here. Great. So basically that is it. What will be the measure? Let's look at the measure. So here you can use maybe 10% or percentage of sales from the new product, right? So percentage of sales from the new product, that is the measure. That's what we are going to use to assess whether we have achieved that goal or not. Good. So if in total our sales revenue is 1,000 Ghana, and out of this 1,000 Ghana, 200 cedis was from the new product, then it represents 20%. Was it the target? Then you are done. Then the responsive supply to, we will talk about that of one-time delivery. So one-time delivery, how do you respond to the suppliers? So here you can talk about one-time delivery. Good. Then I'll add one more to it, customer partnership. Customer partnership, great. So customer partnership, that's where we are now. Customer partnership. And then the measure will be, we have to use what we call the number of cooperative engineering. So number of what? Cooperative engineering. So like the number of associations that we have formed. Then we are done. Let's critically look at the internal innovation quickly to end the game. Okay, so now let's look at the internal perspective. So internal business perspective. With this, we have to just consider the technology, your capability, your manufacturing excellence, and what you call critical success factors. Good. So let's look at the what you call the internal business. So internal business perspective. So you should know the goal and then the measure. That's all. So goal and then the measure. Okay. Now here we will use we set the goal like technology, or you have to use advanced technology, increase in the capability. Yes, the internal process capability. Informally, we can serve 30 customers a day. Now let's serve what? At least 40 customers. Let's improve the capacity. Manufacturing excellence. Here there are many. You can set goals on what? Technology. 1, technology. 2, our capability. Capability. The manufacturing excellence. Manufacturing excellence. 4, you can talk about what? Your design. Design, productivity, new product introduction. All of these can be used or can be set at what? Goal. So design, then productivity. Good. Now the measures we are going to use will be for technology. That's the manufacturing configuration. So how you can produce your, how to be able to produce your goods, manufacture them within some fastest possible time. Then capability, you can use the competition. Yes, the competition to look at it. And then manufacturing excellence, we will use what you call the cycle time. And basically, we are done. Then we are done. Good. So basically, that is it. Then we look at the learning and innovation. The goal set the technology leadership, product focus, and time to the market. It's time that you release your product to the market. I will leave the other section and then we move on. Great. So let's quickly move on. Capability, the measure will be that of the competition. The competition. Good. That's the measure that we are going to use to assess the capability of the entity. So we have to use the competition. Good. Okay. Now let's move on with the game. Let's move on with the game. Good. So we can give a question and we ask you how to design a measure and then set objective under each of the perspective. So we can give you any company at all and we ask you to set objective for that organization. Okay. So that is it. Now that is the end of this section. We are now going to start with the divisional performance measurement, and that's the end of the performance management. So the last aspect is the divisional performance management. So let's quickly go to that section and the entire game. As and on that note, it means that we were able to finish the game. So now we've moved up to divisional performance, the measure of divisional performance. So divisional performance. Now you should know a division. Division means a branch or a unit or a department that operates on its own. That is the division. It's a department or a unit or a branch that operates on its own. So it has its own manager. It can sign contract on its own. Then that is what division. So it means that if we have a company, this is the head office. They have, let's say, division A, division B, division C. It can be departments. It can be units. It can be product or geographical. The divisionalization can be a geographical, product or unit, or even departmental. The bottom line is this: each unit must be what operate on its own. You have your own manager. You don't depend on the head office. No, you're on your own. That will be what division. But if you depend on the head office, you are not a division. You are what a branch. You are just a branch, or but just a mere department. But branch can also be a division if and only if that branch is operating on its own. That is what we are talking about here. So basically, that's a division. Good. Now the division comes in or comes from the decentralization. Decentralization. And then it comes a lot or a number of what advantages. Where the operations, the branches have been allowed to take their own decisions. So the decision has been centralized to the what? To the local managers or to the branch managers. They take their own decision. They take certain contracts without the interference of the head office. That is the decentralization. So we are saying that in general, a divisional structure will lead to decentralization, of the decision making process. Good. Now we can talk about the advantages of the decentralization. Why should you allow the divisions to take their own decision? Why is that we don't take the decision from the central head office? Why is that we don't take the decision from where? Central head office. But we are allowing each of the managers to take their own decision. Good. So the decision will be what? A bit quick and fast, right? Before they have to wait for the central office, time and be fast spent. If you don't have a good means of communication, we wait and wait. Just car, wait and wait. They are not bringing the response. You send a letter there over a month, they've not responded. They tell you we are busy, so we've not seen it. A whole lot of story. But if they should allow you to make a decision for yourself, you don't need consultation. Just put them together, make a decision, send a copy to the other office that this is the decision you take for yourself. That's all. You are done. So decision be taken more quickly. Good. Why? The reason is the information will not pass through the will not pass through long chain of command. Now, before you buy item, maybe you want to go and purchase item over 50,000, it must go to the system. It must go to the divisional manager, go to the central manager, go to the finance manager, finally signed by the internal audit at the head office. In fact, by the time you get the answer to your question, it will be irrelevant and it will take long because of the chain involved. Then it can also improve quality of decision. Why? Because the local managers are well informed than the central managers. Imagine you are the local or the branch, you work there, you are the operational level, you know what goes in there. The guy sitting at the head office, he normally comes to the branch once a week. Oh. Normally comes to the local office once a while, not every day. You are there every day and you know what's going on there. So any decision that you take, it will be very quality. It's not like hearsay, no. It's not like what somebody has reported to you. It's what you have observed and taking critical decisions at it. So that is it. Good. Okay, so we can also talk about it also improve motivation. Wow, I like that. So we are saying that the advantages of decentralization. One, we talk about the quick decision making because you don't need consultation or the decision does not go too long chain. So we talk about quality of the decision. It improves the quality of decision, right? Quality of the decisions because you have the right information, right? Okay, we can also talk about motivation. How does it motivate the employees or the managers? If the local manager is being given the opportunity to make its own decision, he will feel involved and always push for that decision. If we are there and then the central head office make all the decisions for us, then you become useless. So you are just acting on someone's ideas. Meanwhile, you are there, you know what exactly the issue is. Good. And then it also frees up the top level managers. It frees them, make them free so that they can concentrate on what the that of the critical issues. So free management, top level management from their detail involved day-to-day activity. So they can devote more time for the strategic planning. So it frees the top level managers. Top level managers. Great. That is it. Now let's look at the some challenges that we have with that of the decentralization. Now, the major challenge is that sometimes these local managers might deviate from the core purpose of the organization. Yeah, they might not understand the organization's agenda very well. Usually, the top level organization or the top level management, they understand the organization's strategies. Good. And then the other disadvantage will be like this. It might sound like the top level management, they might lose some part of their control. So they will lose control since they are not aware of what is going on in the organization as a whole. So they may lose what? Control. That is it. Okay, now let's look at this and then we are done with that of the performance management. These responsibility centers, I'll list them here. Then you have to talk about them for me. I'll remember them. Read them first. Responsibility centers. What are they? The responsibility centers. That is the cost center. So we have what you call the cost center. We have the revenue. We have the profit. And we have what? The investment center. So these are the responsibility centers that we have. Each manager is responsible for the center. Good. Now you know that the marginal, the absorption costing will be called profit, right? Gross profit. Then if I use the marginal, then you have what you call a contribution center. Good. So contribution center. That is for the marginal basis. Profit center is for the absorption costing. Then we are done. Now, if you're a manager, you only have a control over, if you're a cost center manager have control over cost. Revenue center, only revenue. Even the cost, we talk about the controllable cost. So what you have control over, here is the controllable cost. Not all costs are what? Controllable. Not all costs are controllable. So controllable cost. Revenue, you are interested in only revenue. Profit, you have control over costs and what? Revenue. Cost and revenue. The investment center, you move ahead. Whatever profit is available, you go and then invest it. Good. So that is it. Now, what are we going to use to measure the divisional performance, especially if we are the investment center? Investment center, you are interested in that of the price, the sales prices, and the investment in non-current assets. How will the company get the asset? How the company get investment? That's all. We are done. Now let's go to the measurement. So measuring the divisional performance. How do you measure the divisional performance? We are going to use two important measures. Then we are done. Divisional performance. how to measure the divisional performance. First, we are going to look at the return on investment. Return on investment, popularly known as ROI, the ROI. Then we look at what we call residual income. Then we are done for the day, and that's the end of the game. Residual income. You can also call it what? RI. Return on investment, residual income, then we are done. So let's see. We will explain each of them and then we cite a formula to calculate each of them, and that is the end of the game. And that is the end of the game. Now, the performance of an investment center is usually monitored using any of these methods. So the investment center, your performance is being measured using what? The return on investment or the residual income. So that's why we are going to calculate the residual income. It's fall under the responsibility center, into bracket what? The investment center. So when they ask you if you're a manager of the investment center of company, let's say Target PLC, what will be the performance indicators or the measurements are you going to use to measure the performance? Good. Now, return on investment is generally regarded as the key performance measures. In fact, we like using it. You can also call it the accounting rate of return. Why do we like using the return on investment? Because it conforms with the accounting practice. It's directly linked with what? Accounting practice. Let's look at the formula. It's equal to your profit before tax. That's operating profits. So profit before tax, all divided by capital employed. Capital employed times 100. Please, this profit is after tax, so before tax, but must be after depreciation. So let me write here, after what? Depreciation, very important. That's all. So let's cite a nice example. Or let's use, how do you call it? The questions in the handout. So I will project some question here, then we look at it. Cool, then we look at it. Now the question is, how do you get the capital employed? Now the capital employed is nothing by your, I'll give three formulas, all of them will give the same answer. So capital employed is nothing by first the non-current asset plus working capital. Working capital. Or method 2, total asset minus current liability. The last one will be equity plus non-current liability. This is how we are going to calculate the the capital employed, and that's all. So let's see if we can pick one nice question. I've uploaded a question. Now let's check our one example. Let's check our one example. Now, target PLC have two divisions. So target PLC, two divisions. So target PLC. So let me write it here. Still Apple. I'll not write plenty. Target PLC have two divisions. The divisions are the consultation or the consult session and the publications. Okay. So these are the divisions. Performance for 2006 or 2016 is as follows. So revenue, I write something here for you. Revenue. The consulting service was able to produce revenue of 60,000, but the publication produced revenue of what? 40,000. Cost of sales or operating cost. Operating cost, yes, 40,000. Yes, let's say 15,000. So here is what? Operating profit. 20,000. Yes, 15,000. Sorry, 25,000. Yeah, set down question though. Taxation. Yes, 5,000. And here happen to be 6,000. Sorry. So the profit after tax will be anti-parts 15,000. And here's what? 19,000. I like that. Okay. Let's continue again. Extracts from the profit and loss statement is as follows. Non-current assets happen to be 50,000. Yes, 45,000. Current assets happen to be just 40,000. And here non-current asset is 15,000. Then current liability happen to be current liability is, let's say, there's 30,000. Here's 10,000. Then equity. Okay, so non-current liability. Then equity. Non-current liability is 10,000. Equity is what? Here must be 20. No. Yeah, it's 10,000. And here is 50,000. It's to balance. The financial position must balance. So this and this is 60. So 50. 60, 50, 50, 50. So here's 5,000. Here's 10, 40,000. So 45,000. I'm done. Required. Calculate the return on investment for the two divisions and analyze the performance of the division. Analyze the performance of the division. So that is it. So Target PLC possesses two divisions, consult section and publication. So let's solve it here. Tell the examiner that if you are looking for that of the return on investment, so I write here return on investment boldly. Tell the examiner, write it here again, return on investment. I write a formula here. I write the company, the consulting service, the publication. So the formula will be, so let me put the formula here. So let me step this guy down a bit. So the formula will be, the more I write, the more I remember. It's equal to profit before tax, but it must be after depreciation. All divided by capital employed. That's all. So what's the profit before tax? That is operating profit, right? So 20,000 for that of the concepts, 25,000 for the publication. So concept will be 20,000, all divided by, so yes, also 25,000. Let's look for the capital employed. In fact, this and this is 90. This and this is also 90 as balance. 90, 90. And this and this is also 60. This and this is also 60. Yes, that's also balance. So the capital employed here is any method. Capital employed can tell the examiner is equal to total asset minus the current liability, or non-current asset plus the working capital. So total asset to be 90, right? Less the current liability of what? 30. I like that. So 90 minus what? 30. That's the capital employed. Or we said that you can also start the equity plus non-current liability can also give you capital employed. That's also 60. Whichever way you go, you get a 60 answer. So basically that is. So the capital employed here is 60. Can you show working how you got the 60,000? So if I want to show working, after there's on a working number one, I pick the total asset of 50,000 plus 40,000, making 90,000. This is the total asset. Less what? The current liability of 30,000. That's the method one. Method two, non-current asset of 50 plus into bracket working capital, which is the 40,000 less 30,000. That'll give me 60. Then working three, equity plus non-current what? Liability. And that one also give us what? 60. So whichever method that you use, the answer must be the same. What about here too? Total asset is 60 less the current liability, which is what? 10. So that will give us, so 50, 60 minus 10, that will give us 50,000. And this all times 100. This one 2 times what? 100. Perfect. So now what is the return on investment? Divisional investment. So 20,000 times 100%, so that's 1, goes here 3. So that's 1/3. So 33 1/3%. So 33.33%. And the second one, you get what? 25 out of 50. So that's 50%. Yes, 50%. So tell us which of the division is performing well in a target PLC. Which of the division is performing well within target PLC. Which of the division is performing well within target PLC? Which of the division is performing well? Clearly, it can be seen that the publication is doing well than what the consulting. With a return on investment of what 50% is doing well. That's all. Here we are just going to measure divisional performance. I'm done. Now let me add one item to it and then I'll just be changing stuff. Now let's look at the residual income. The formula residual income. With the residual income, here we are interested in the profit, the same profit that we use. So say that profit, the formula is profit before tax, but it must be after depreciation, less what? Less what you call implicit cost or the interest cost or the cost of capital. Cost of capital. So I'll call it implicit cost or let's call it interest. That's all. Now here, how do you get it? They'll give you the cost of capital or cost of finance, so cost of capital times the capital employed. That's all. So the capital employed times the cost of capital. So here, let's assume that target PLC, our cost of capital is 12%. So target PLC have a cost of capital of what? 12%. So cost of capital is 12%. That's the target PLC's cost of capital. So 12%. So what do? We have to now look for the profit before tax. Then we less all this for me. So let's do that one too here. Right? Residual income. The more I read the formula, the more I remember. Is the profit before tax less the interest. So for 2000 and I'll start by saying that the profits, all right, here profits. For consulting, their profit is 20,000. So I just have to bring the same profit here. Publication is 25,000. Less what? The interest. What's the capital employed? The capital employed is here 60,000. So you pick your calculator, tell the examiner that this 60% times 12. So the cost of capital times your the 60%, the 60,000, and this will give us 7,200, right? Then do the same thing for here. It will be 12% times your 50,000. That's the so 12% times 50,000 give us that will give us 6,000, right? So you take it off, and then the residual income is so this is the residual income. Residual income. So 20,000 less 7,200. So that's 13. 12,000 was 800. Yeah, 25,000 minus 6. That's what 19,000. We are done. So that is the residual income. Now we can give you question that require for depreciation. This is the general view. Now let's start the massage. And then add the exams flavor to it or the exams mix to it. We can give you a question and we tell you that the asset has not been depreciated and the examiner is fully aware that as you are getting to the end of management accounting, you've come across depreciation. So you are very versatile in terms of depreciation calculation. So all I have to do is calculate the depreciation, subtract it from the profit, subtract it from where? The capital employed. That's all. Good. Because it will reduce the cost of the assets and then you are done. Now let me add the last item to it, and that's the end of the game. After that, we scan through the exam pass question to just look at the critical section that we have to. Good. Okay. Now let's see. What if the consulting section, I'm going to add a footnote to it. The footnote to it. So here all I need is a profit. So I'll summarize it again. All I need is a profit, which is 20,000. So let me record it here, and capital employed. So here, right here, profit, net operating profit, net operating profit. Trouble. So let me just call it profit before tax, but it's after depreciation. Now the consult, our own is what? 20,000, and then here is 25,000. Good. It's a capital employed. Here was 60,000 and 50,000. That's all. All these clean. Yes, the cost of capital is still 12%. Cost of capital is still 12%. These are the footnotes. Note 1. The consult division. The consult division is considering an acquisition of new assets or new investments at a cost of 20,000 cedis and will yield a profit of 5,000 cedis per year. Profit of what? 5,000 cedis per year. So profit of 5,000 cedis per year. And full stop. Note 2. The publication is also considering disposing of one of its plants or one of its printers, one of its giant printers or plants at a plant with a carrying amount of 15,000 cedis, which generate profit of 5,000 We generate a profit. We generate a profit of 2,500 per year. Full stop. The note 3 is the cost of capital. It's still 12%. Great. Note 3 is the cost of capital. It's still 12%. So let me write it here. 12%. You are done. Calculate the residual, the return on investments and the residual income after, before, and then after the investment. So for each of the division. So here, let's see how best we can do this. It's basically the same as the old one, but the issue is that the company that will, before and after, before they calculated it, we have 33.3%. So we are going to calculate it after. What we did first was the before. So before, what do? Take the profit divided by what? The capital employed, you are done. Take the profit divided by capital employed, you are done. That is the before. The same thing applies to the residual income, and that's what we calculated. So I will not do that one again. So even though they have asked us to do the before. So when I say before, I'll put here refer from the previous solution. That's all. Let's go to after. Or I can write the answers here. Before, we are 33.3%. In fact, that means I'll write the residual income too. So in fact, refer. In simple note, refer. That's the solution there. So after, that's where my interest is. The after, let me bring the return on investment. Let's take the first company, the consulting company. If you take the consulting company, for instance, and their publication, you realize that the consulting company bought additional what? Investment or assets. So in a way, it will increase it what? Capital employed. Sharp. So anytime they acquire, just add. When they sell, subtract, you are done. When they acquire, it will increase their net assets. It will increase the company's assets. So add. And it also increase the profit. So what do? They bought a new investment at what? 20,000 to add to the existing investment or existing capital employed of what? 60,000. And that one will give them a profit of 5,000. So you add this profit to what? To this, to 25. So therefore, here will be something like the old profit plus the new one, making 25,000, all divided by the 60,000 plus the 20,000 times 100. We are done. So that is how we do the after the acquisition. What about the publications? With the publications, they rather disposed of, they sold some of their investments. So what do? That one, if you are selling, you have to subtract, right? So the capital they have is 50, and they sold asset or a plant with a carrying amount of what? 15,000. So that one you take it off because you are selling it. Good. So let me do that one also here small. So here the profit too is 25 less what? The one that is going. So 2,500. So 25,000 less 2,500, all divided by the 50,000 less 15,000. Don't forget that all times what? 100. That's all times 100. Now please, what is the answer? What is the answer? If you answer ready, kindly let me have them. So 2,000, so that would be 25,000, 25,000, 1, 2, 3, divided by the 80,000, 1, 2, 3, so times 100. That's 31.25%. 31.25%. 31.25%. Okay, with the requirement, you are calculating the return on investment before and after the investment. So before and after. And the before is the same as what we've calculated previously. So we are looking at the after. After they consider this, after the consult by the asset and publication also dispose of the asset, what will be the return on investment? And the residual income. We are doing all the two together. Good. So here too will be what? 22,500. 22,500 divided by what? 35,000. 1, 2, 3. Times what? 100. So still, your return is going up 64.29. We are done. Let's go to residual income. Residual income. So residual income here now become the 25,000, right? So that's the profit. So now the residual income, how do you get the residual income? So we start profit. So the profit after everything will be 25,000 for that of the consult. Over here will be 22,500. And the interest or the implicit cost, you open your bracket. 20 plus 60 will give us 80. Agreed. So the 80 times the 12%, that's the cost of capital. 12% given to us in the question. So 12% of what? 80,000 will give us. So dot 12 times 80. That's 9,600. So it'll be 9,600. So therefore, it will give us residual income of, so 25 less 9.6. That gives us 15,400. So 15,400. So basically, that is the residual income, 15,400. After the disposal or acquisition of the investment. Now, when you come here, this one is 80%, 80,000 times 12. Oh, yes, times 12%. Times 12%. Over here, you take 15,000 from 50,000, you get something like 35. Then you multiply 12% by it, right? Because they have 50,000, they are selling 50, so let me do what? 35. So multiply 35 by 12%, so 35,000 times dot 12. That'll give us 4,200. Agreed. So let me check it again. 12 dot 12 times what? 35. 1, 2, 3. Good. So 4,200. So less 4,200. If you take it off, what do you get? So store. Yes, I like that. So here will be 18,300. Perfect. I'll take that. So that's the residual income. 18,300. We are done. I'm going to explain only 2 sections, then that's the end of performance management. Now that we know before and after. The second section is this. Please, this profit, we need what you call controllable profit. The profit, we need controllable profit. So you have to pick what you call controllable cost. Don't pick any cost that goes beyond what? The control of that division. Because we saw that responsibility center, you have to pick what you call controllable. And the question is this: what if the head office? Why is that we don't pick the profit after tax and pick the profit before tax? Because tax is not controllable. Let's assume that the head office have built them with that of Consult, head office apportion expenses. So head office, I'm just assuming that head office apportion expenses here is 2,000 and here is 2,500. So the head office have told them we are not going to consider that because that one is what? Non-controllable. Yes, head office expenses that apportion, we've sent the proportion of the head office expense to the branch for them to pay. It should not be part of the branch assessment because that cost, they don't have control over it. It's coming from the head office. So please don't pick it. Some of the questions, they will ask you to calculate what you call controllable profit. Profit that that branch have control over. One is what he sell, what he pay. So the branch revenue and the branch cost, that's all. Any cost coming from the head office should not be part. Why? Because that one the branch doesn't have control over. It's like when CEO is going sign off for CEO at least. And you go to the branches, take some small contribution, go and give to the CEO. Yes, that one should not be part of the assessment. And that's the first thing I'll talk about. Then, what again? What together? Okay, let's look at these questions. We'll look at some critical questions that I've compiled on this so far. We scan through them and then we'll go to the last two sittings past questions. And that's the end of the game. Transfer pricing, we explained later. Great, so let's see. If you do have any question, kindly let me know before we move on. Great, now let's look at the advantages and disadvantages of these two measures. Advantages and disadvantages of these two measures. Before I scan through the past questions, let's look at the advantages and then disadvantages. Now the issue is that as the one, in fact, the return on investment is the most common method. The most common method because it's simple and it's confirmed with accounting profit. That's the advantage. It's confirmed with what? The accounting profit or the accounting style of obtaining the profits. And then two, it's easy to understand. The only challenge is that for that challenge is a great challenge with that of the return on investment. As the asset, the division's asset is getting older. Okay, the first one, we said that it's easy and then the most common form because it conforms with the accounting profits. It conforms with the accounting profit. So like how we've calculated the accounting profit, the same thing we are going to calculate the divisional performance. So in a way, it's simple, easy to understand. Simple, easy to understand. So advantages of the ROI. 1, 2. It's simple. It's simple and easy to understand. 2. It uses accounting profit, which is easy to be determined or which conform with the accounting practice. So it uses accounting profit. It uses accounting profit. And you know, all of us, most of us, or most of them are very good when it comes to accounting profit. They can estimate it for you. But when it comes to cash flow,
how to estimate cash flow is a bit difficult than how to estimate profits.
Then the disadvantage. It has a major challenge. The major challenge is that as the assets is getting older, the return on investment gives a false impression. Wow. That's the major challenge of the return on investments. Let me write that one down. As the asset is becoming older or is getting older, the ROI gives wrong impression. And we'll back with illustration. Yes, we'll back with illustration. Now, disadvantage. We said that the assets as the assets are getting older, the ROI, that's the return on investment, gives a wrong impression. Wrong impression. It means that as the assets are going older, the ROI will be increasing. That's the meaning. ROI will be increasing. ROI will be increasing, telling us that we are doing well. And in fact, it's a lie. Because we said that profit before tax all divided by capital employed. As the years, depreciation will reduce the capital employed because we subtract from the non-current asset. So as this one goes down, while this one increases or still the same, it will increase the percentage, giving a sign that we are doing well. In actual sense, in fact, you have not done anything good. And let's see an illustration for this. So let's see this question. Now, critically, let's see this. So, for example, the result of investments in tax with a policy of straight line depreciation of asset over a 5-year period. Now, the cost of the asset is 100. Depreciation is what? 5 years, so to be 20. So the carrying amount of the asset is what? 80. Great. Good. So 80. 80 then plus what? The working capital. And that will give us what you call capital employed. So that here we use the average. Here we just find the average. So 100 minus 20 normally give us 80. But on average, we pick the 90. Then we add working capital to it to get 100. Now the profit is 10. You can see that the return on investment initially is what? 10%, increasing. It's because the asset value is reducing. Because the asset value is what? Reducing. So that's why it's giving a wrong impression that we have improved the performance. In actual sense, it's not true. Good. Okay, so basically that is it. So we will scan through our past question and then last two settings on, then we see, so that you now decide on your section. Good. Please have sent the tutor in and we can use that one. Okay, now let's see the game. Let's see the game. Of course, you can add that one also to it as a disadvantage. So accounting profit to you can tell the examiner that it's subject to what? Manipulation, right? Or it can be affected by selective accounting policies. So if you look at the policy, we select a different policy for valuing your items to give a different impression. Okay, so now let's look at this set of questions. The initial section wasn't coming clear, but what can you do? We start from here. Question 5. Wahab Ventures has been in business for over 10 years. The company's assets and profits at the end of December 2009 were as follows. Fixed asset book value 300,000. Net current assets. Net current asset means working capital. So you add it, you get 340. Net profit before tax. I like that because you have to pay profit before tax, but it must be after depreciation. Good. So if the asset has not been depreciated, what do? Depreciate it. You are done. The fixed asset consists of 5 separate items, each cost 60,000. 5 separate items, each one cost was 60. So 5, 6, 30. So that's the 300,000 now you have there, which are depreciated to zero over 5 years on straight line basis. For each of the past years on 31st December, it had bought a replacement for the asset and had just been withdrawn, and it proposed to continue this policy. The assets manufacturer has been able to keep his price constant over the time because of technological advancement. Directors of the company believe that there will be no changes in the data presented above. However, the following opportunities are available. What are the opportunities? Have you seen? An investment costing 60,000, which will yield an annual profit of 10,000. So they are going to buy. They are going to buy a new asset. When they are buying asset, add to the existing details. You are done. An asset that currently earns 3,900 annually would be sold at a price equal to its written down book value of 24. So if you're going to sell it at 24, what do? You take it off. That means we are adding 60 and we are subtracting 24. That of the work capital employed. With the profit section, we are adding 10,000, we are taking 3,900 out because we are disposing them off. We are done. Now look at the questions. The questions are critical. So calculate the new ROCE. That's the return on what? Capital employed, which is also called the return on investment. And the residual income if the investment was undertaken, just the investment. So we are only considering the 60 and 8 profit of 10,000. That one, you don't need to consider the second section, the II. No, it will affect the B. They say calculate the new ROCE and return on investment if the assets were sold. So that one, you pick only the sold. State with reasons whether you recommend the investment to be undertaken or the asset should be sold. You pick the one that offers the best position, then that's all. Identify and explain some reasons for decentralization. We did that, right? Identify and explain some of the reasons for decentralization. Because normally divisions cause for decentralization. So take note of that and read wide about decentralization. Good. Read wide. Expand the knowledge there. Good. So that's your question. Now let's go to question 6. Explain each of the underlisted measures which may be used for divisional performance measurements. Discuss the advantages and problems associated with the use of each. Return on capital employed, residual income. That's what? 10 marks. This question dropped in November 2017. But this question is a very old one. It dropped 2012, 13 thereabout, but it was repeated again. Great. Now let's go to the B part of it. Dromo Limited is a divisional company. It has two divisions called Na and Hewo. So Na Hewo. Na's operation include milling and dealings in the grain market. Milling. Hewo operates a number of what bakeries. Wow. The following data relate to the year ended 30th October 2009. Still, gain on plant. Direct material is there. Direct labor is there. Divisional variety is there. Depreciation, I like that. Depreciation. Head office cost allocated, no. This one, you don't need to include it too because it's what? Non-controllable. It means that this question, they might ask us to calculate what you call controllable profit. If you are calculating controllable profit, do not consider the head office cost or any cost that the division does not have control over. The division have control over their own costs, but not the one coming from the head office. It has been imposed on them by force, whether they like it or not. They'll bear it. They don't have say. Fixed assets, costless accumulated depreciation, all of them are there. Stock, trade receivable, cash at bank, bank overdraft, trade payable. So this one you have to deduce the working capital, and then you find what? The capital employed. The ultimate goal is capital employed. So you have to deduce it from this and then you are done. Calculate the capital employed. Calculate the controllable profit. Do not include this figure. Then you are done. Let's see. Divisional management DMs given authority to spend up to 25,000 on capital items as long as the total spending remains within an amount provided for small projects in annual budget. Larger projects as well as sales and an asset with book values in excess of 25,000 must be submitted to the central management CM. Decision has been made that the divisional manager's performance should be appraised on basis of what? Controllable profit. I like that too. This examiner is good though. This measure would include depreciation and gain or losses of assets, treating investment on fixed asset as what? The central management responsibility. Cost of capital for Dromo Limited is what? 20% per annum. Required. Calculate for both division on the following three measures. 1. Return on capital employed. That's a return on investment. 2. Residual income. 3. Controllable profits. Controllable profits. We are done. Now let's move on. All these ones are your past questions selected. Discard three methods that can be used to fix transfer pricing. The Global Emacs has two divisions, one located at Tema and other is Kumasi. The following extract is from the annual report for 2010 financial year. Profit before depreciation. I like the question. This profit is before what? Depreciation. Meanwhile, we are looking for profit after depreciation, but must be before tax. Great. So you just have to less the depreciation from it. Non-current asset, 1,200. That's 1.2 million and 1.3 million respectively. Current asset is there. Current liability is also there. The company's cost of capital is 20%. Now here, don't forget to less the depreciation from the non-current asset to get the carrying amount. That means the depreciation has not been subtracted from the cost. So this is the cost of the non-current asset. So we can take off the depreciation from it. Depreciation has not been subtracted. So you have to take it off and you are done. Then you find for what? The capital employed. So use this one to deduce the capital employed. We said that is the total asset less what? Current liabilities. You are done. You come and they ask you for using return on investment and residual income. Comment on the performance of the division. Which of the division is doing well? With reasons. Now look at this note. Kumasi branch intends to sell one of its non-current assets with a book value of what? 120,000 and make a profit of 60,000. Full stop. CIMA also want to acquire another asset costing 90,000 that will generate a profit of 40,000. To what extent would the decision affect the performance of the divisions? We just have to calculate the new items. That's all. Calculate the new return on investment and the new residual income, and then check whether it has increased or it has decreased. That's the end of the game. Now let's move on with the game. Enim, Mr. Enim. Good. I like this question. Whilst managers can use different leadership style, they are all share the task of utilizing information to make decisions that organizational goals. Accounting information for decision making will differ from each person. Explain three qualities of management accounting information. This one dropped in November 2019. Either the intro, it dropped in the management accounting, either the intro or the one at level 2. Three qualities of management accounting information. It must be accurate, in the sense that accurate, cost effective, reliable, time assigned, and then those stuff. The cost benefit analysis. B. Explain in brief the following terminologies as used in performance evaluation, highlighting their managerial objectives and their performance measurement indexes. Here's performance management what measures. So cost center, revenues and profit center, investment center. So what are they? And then what's their performance measurement index? That's the indicators. Performance measurement indicators. So for cost center, what's the performance measurement indicator? So reduction in cost. So the center where you accumulate cost. And then the manager is responsible for cost, controllable cost. Revenue. Revenue center is where you accumulate revenue. Manager is responsible for what? Only revenue. Profit center, you are responsible for both cost and revenue. Good. And you can use what? The receipt to measure, and then the net profits. Investment center goes beyond the you combine the revenue and profit together plus the cost. Good. And then the measurement that you can use at the investment center, or the measure, is the return on investment or residual income. These are the measures that you can use there. Then question 13. Compare and contrast the use of residual income and return on investment in divisional performance measurement, stating the advantages. You are done. Is it? Wow. This question is a recent one. It's around 2017 or 2018 May. The bottle labeling division of Crash Drink Limited. Crash Drink. The bottle labeling division of Crash Drink Limited currently has capital employed of what? 100,000, and earns an annual profit after depreciation. I like that too, of 18,000. The divisional manager is considering an investment of 10,000 in an asset which will have a 10-year life with no residual value and will earn a constant annual profit after depreciation of 1,600. The cost of capital is 15% per annum required. Calculate the following and comment on the result. The return on divisional investment before and after. Before and after the new investment. Divisional residual income before and after. 8 marks. Solid. That was November 2018 or the May 2018. It's quite recent. And it followed like that. Plenty like that. Everything was like that. Here to the same thing. Capital required. Here's it. is there, 82.8 million, everything is there. Net profit margin is there. Now this in here, they've not given you the net profit margin, you have to generate it yourself. How do you find net profit margin? Is the net profit over the sales times 100. So you just multiply this 28% by this, it will give you the net profit in value. Multiply 33% by 21.8 million to give you what? The net profit value. You are done. Before you can divide it by the capital employed. Good. Now the company is seeking to maximize shareholders' what? Assuming that Division A acquires more efficient asset at what? 50 million, and Division B sold one of its assets with a written down value of 24 million, and profits are expected to increase and decrease by 11 million and 5 million for Division A and B respectively. That one we need it for the second one. Calculate and comment on the effect of the decision to invest in the new asset and dispose of some assets will have on the current ROI and then the return on that's the current return on investment and the residual income. Okay, great. So basically that is it. So for the past years, consistently, this question has been with us. Good. Now let me go through last sentence question, and then we are done for the, and that's the end of management accounting, and that is the end of performance management. Great. So I hope you have looked at the various ways. Until recently, that they've changed the trend later. I'll, I'll walk you through all of them, how the recent one was asked, and then how the last sentence on to was asked. Okay. So we look at these two questions, then we are done. So you're going to look at 2019 May and 2019 November and 2020 May. Go these two questions. 2019 November and 2020 May. So this is 2020 November, eh? Okay, so I hope you saw your question, right? 2020 November, you saw it in, right? Good, when we are listing the question. So now the questions are in. Let's go for them. This 2020 May. Let's look at the 2019 November. 2019 November. 2019 November. Good. 2019 November. I like that. Okay, that was the question that we saw. The one I added it to the. Okay, this is the 2019 November. Great. So that means the first handout, this handout, it contains all performance management questions so far, all of them so far. Look at the 2020's own. But there was a question that dropped, which was a question. Then I'm looking for another question again. There was a question. There was a question that 20. Okay, this is 2019 May. This 2019 May. Let's go 2019 November. That question, I like it too. That question was very good. Good. So now we are here. 2019 November. Question 1. Oh, GRAT Limited. GRAT. And this is coming from the question bank. Dito with the same figures. Everything the same. With the same marking scheme. Good. The old question bank. So calculate the following ratio for GRAT Limited. So have you seen the ratios? Return on capital employed, net profit margin, asset turnover, current ratio, 8 marks. Evaluate the performance of the entity as reviewed by the above ratios. So these ones are financial. Just that when we ask financial section management accounting without a non-financial, it is incomplete. So look at the C section. Suggest 3 non-financial indicators that could be useful in measuring the performance of a passenger railway service and explain why your chosen indicators are important. Everything is detailed from the question bank. Wait, so this is November 2019 and explain the short term, that's the short termism, and then suggest ways in which the long term view can be encouraged. So I've seen the performance management question for November 2019. Now let's go to 2020. 2020 May. This one is a very long one, 2 pages question. It's that from a voter advisory limited. Voter. It talks plenty, it gives a lot of non-financial and non-financial information, a lot. So the following actual results: number of clients for the 3-year period, number of complaints from clients, number of accounts in dispute, support desk percentage, everything. Number of consultation, that's the consultations, number of workshops given. When you are done with acts required. Using the information provided, analyze and discuss the performance of what's the name? Voter Advisory Limited. Let's go. Voter Advisory Limited. For the year ended 31st December 2016, under the following headings. For the year ended what? 31st December 2016. So they are looking for 2016. Agreed. So the central focus must be on 2016, but with a reference to what? 2014, 2015. Great. On the headings of the following: financial performance. I like that. That is the how do you call it? The financial perspective using the ratios, financial indicators, competitiveness. That's the non-financial information, changing the cost structure, internal efficiency, non-financial, external effectiveness, 20 solid marks. Great. So that is the end of today's section. So can you go through all this? If there's any issue, let me know and you'll be fine. This is how far the good Lord will bring us. In fact, we have a very long class today, and I'll thank everybody for doing that. Thank you. All these materials have been uploaded on your platform, so kindly can use that for your revision. Okay. Goodbye, everyone.